The most significant changes in global power rarely announce themselves with fanfare. They unfold in boardrooms and ports and oil fields over years while headlines chase smaller fires. By the time markets react, the structural shift has already happened. What we are witnessing in Venezuela is not a sudden crisis. It is the visible result of decisions made a decade ago. China has positioned itself as the dominant force in one of the world's largest oil reserves, and the implications extend far beyond a single country or a single commodity. This is about how nations secure resources when traditional alliances fracture, and how patient capital reshapes geopolitics while others debate quarterly earnings. Venezuela sits on the largest proven oil reserves in the world. Estimates place those reserves at roughly 300 billion barrels. That is more than Saudi Arabia, more than Canada, more than any other nation on earth. But reserves alone do not create power. Accessibility matters, infrastructure matters, the ability to extract, refine, and deliver oil to market matters even more. Venezuela's oil is heavy crude. It requires specialized refineries and significant investment to process. For decades, Venezuela relied on a combination of state control and foreign partnerships to manage its oil sector. That model worked when prices were high and when technical expertise flowed freely. It collapsed when economic mismanagement and political instability combined with falling oil prices and tightening sanctions. By the mid-2010s, Venezuela faced a choice. Its economy was in free fall. Inflation spiraled into hyperinflation. Oil production, which had been the backbone of government revenue, dropped by more than half. The United States had imposed sanctions targeting the government and the oil industry. Access to Western capital dried up. Traditional partners pulled back. In that moment of maximum vulnerability, China stepped forward not as a lender of last resort, but as a strategic investor with a very long time horizon. China's approach to resource security is fundamentally different from the way Western powers have traditionally operated. Western investment tends to follow market logic. It flows toward returns and retreats when risk rises. It responds to quarterly performance and shareholder pressure. China operates through state-backed institutions with mandates that extend decades into the future. The goal is not immediate profit. The goal is securing access to the resources required to sustain growth and independence. In a world where supply chains are weapons and energy is leverage, China structured its engagement with Venezuela through oil-backed loans. The mechanics are straightforward. China lends billions of dollars to Venezuela. In exchange, Venezuela commits to repaying those loans not in currency but in oil. The oil is delivered at agreed prices directly to Chinese refineries. This arrangement serves multiple purposes. It gives Venezuela access to capital when no one else will provide it. It gives China a stable long-term supply of crude that bypasses volatile spot markets. It creates dependency. Venezuela cannot easily walk away from these agreements because it has no other source of capital and no other buyer willing to take on the political and operational risk. Over the past 15 years, China has lent Venezuela more than $60 billion. Much of that debt remains unpaid in traditional terms, but it is being serviced through oil shipments. Chinese state-owned companies have also taken equity stakes in Venezuelan oil projects. They have invested in infrastructure, including refineries and ports. They have provided technical expertise and equipment. In effect, China has woven itself into the operational fabric of Venezuela's oil sector in ways that are difficult to reverse, even if political winds shift. This is not about ideology. It is about incentives. Venezuela needed capital and had oil. China needed oil and had capital. The transaction logic is clean, but the strategic consequences are profound. When a nation controls access to another nation's primary source of revenue, it holds leverage that extends into every aspect of policy. China does not need to issue directives. The dependency itself shapes decisions. It determines who Venezuela can align with and who it cannot. It determines which markets are prioritized and which are secondary. It shifts the center of gravity in hemispheric relations. The United States once held that position. For much of the 20th century, American companies dominated Venezuela's oil industry. American refineries were designed to process Venezuelan crude. American capital funded expansion. American influence was a given. That influence eroded gradually. It did not vanish in a single event. Economic mismanagement under successive Venezuelan governments created instability. Nationalization of the oil industry in the 1970s shifted control away from foreign companies. Political tensions rose. By the time Hugo Chavez came to power in the late 1990s, the relationship was already strained. Chavez positioned himself in opposition to Washington. He sought alliances elsewhere. He found willing partners in Russia and China. The United States responded with sanctions. Sanctions are a tool designed to impose costs and change behavior. They can be effective when the target has limited alternatives and when the costs of compliance are lower than the costs of defiance. In Venezuela's case, sanctions accelerated the shift toward China rather than reversing it. Sanctions cut Venezuela off from Western financial systems. They restricted access to technology and spare parts needed to maintain oil infrastructure. They targeted key individuals and entities. The intended effect was to pressure the government into political and economic reform. The actual effect was to make Venezuela more dependent on the few partners still willing to engage. China was not deterred by sanctions. It saw an opportunity. This dynamic illustrates a broader point. Sanctions reshape behavior, but they do not always produce the outcomes their architects envision. When you cut off access to capital and markets, you force the target to find alternatives. If those alternatives exist, the target adapts. The leverage you hope to gain diminishes. In this case, the alternative was China, and China was patient and willing and capable. Energy security has always been central to foreign policy. Nations that control energy supplies hold strategic power. Nations that depend on imports remain vulnerable. The United States achieved energy independence through the shale revolution. That independence reduced the urgency of maintaining influence in traditional oil-producing regions. It allowed for a more selective approach to foreign engagement. But energy markets are global. What happens in Venezuela affects supply dynamics everywhere. If China secures a dominant position in Venezuelan oil, it gains leverage, not just over Venezuela, but over global energy flows. Oil markets adjust slowly, and then suddenly, traders react to headlines. Prices spike on geopolitical tensions. But structural shifts take time to manifest. When supply chains reconfigure, when long-term contracts lock in volumes, when infrastructure investments create new routes to market, the effects compound over years. By the time the market fully prices in the new reality, the advantage has already been captured. China's position in Venezuela is one of those slow-building advantages. It does not make headlines every day. It does not trigger immediate price shocks, but it represents an inaudible shift in who controls supply and who bears risk. History offers useful parallels. In the 1970s and 80s, Japan secured long-term supply agreements for natural resources across Asia and Latin America. Those agreements were expensive. They were criticized as overpaying, but they ensured that Japan had access to the inputs required for industrial growth during a critical period. Decades later, those investments look prescient. China is following a similar playbook at a much larger scale. It is locking in access to oil in Venezuela. It is doing the same in Africa and the Middle East and Central Asia. The goal is not to maximize short-term returns. The goal is to eliminate vulnerability. For emerging markets, this dynamic creates both risks and opportunities. Countries with resources but limited capital can attract Chinese investment when Western investors retreat. That investment can fund infrastructure and development. But it comes with strings. Debt must be serviced. Political alignment becomes harder to avoid. Sovereignty is not surrendered outright, but it is constrained. Venezuela is an extreme case, but the pattern is visible elsewhere. Zambia, Sri Lanka, Ecuador. Nations that accepted large Chinese loans found themselves navigating complex trade-offs when repayment became difficult. Global trade adjusts around these shifts. If Venezuelan oil flows primarily to China, then our buyers must source crude elsewhere. That affects pricing in regional markets. It affects refining capacity. It affects shipping routes. The United States imports less Venezuelan crude than it did 2 decades ago, but American refineries along the Gulf Coast were built to process heavy crude. When Venezuelan supply is redirected, those refineries must adapt or find substitutes. Canada provides some, Mexico provides some, but the substitution is not perfect and it is not costless. Looking forward over the next decade, China's position in Venezuela is likely to deepen rather than reverse. There is no credible scenario in which Venezuela repays its debt to China in full. There is no alternative source of capital willing to displace Chinese investment. Political change in Venezuela might alter the rhetoric, but it will not change the underlying incentive structure. Whoever governs will need revenue. Oil is the only significant source. China is the buyer and the lender with the most at stake. That creates continuity even through political volatility. For oil prices, the implications are more complex. On one hand, removing Venezuelan supply from open markets tightens availability for other buyers. That should support prices. On the other hand, global supply is elastic. Producers elsewhere respond to higher prices by increasing output. Technology improves. New reserves come online. The net effect on prices depends on the balance of these forces. What is certain is that the strategic landscape has shifted. A major reserve base is no longer accessible to the United States or its allies in the way it once was. That matters less for price than for leverage and optionality. Strategic positioning in energy is about options. The more sources of supply you control or influence, the more flexibility you have when conditions change. The fewer options you have, the more vulnerable you become, to disruptions or to pressure from those who do control supply. China is methodically expanding its options. It is doing so not through military force, but through financial leverage and long-term commitments. That approach is less visible than traditional geopolitical competition, but it is no less effective. The United States retains significant advantages. It has the world's largest economy. It has a dominant financial system. It has technological leadership in many sectors. It has military power that no other nation can match. But influence in specific regions and over specific resources is not guaranteed by those advantages. It must be maintained through engagement and through offering value that others cannot easily replace. In Venezuela, the United States chose sanctions and isolation. China chose investment and engagement. The results speak for themselves. Markets often underestimate slow strategic shifts because they do not generate immediate visible impacts. A loan agreement does not move prices. An infrastructure investment does not trigger headlines. But over time, these accumulate. They create path dependencies. They shift the default assumptions about who controls what and who can do what. By the time the shift is obvious, it is already entrenched. The lesson here is not that China has won and the United States has lost. Geopolitics is not a zero-sum game over short horizons, but it is a competition for durable advantage. China has secured a durable advantage in Venezuela. That advantage will compound. It will shape decisions in Caracas. It will influence energy flows. It will affect how other nations in Latin America assess their options. It will contribute to a broader realignment in which Chinese influence expands in regions that were once firmly within the American sphere. Understanding these dynamics requires patience. It requires looking past the noise of daily headlines and focusing on incentives and structures. It requires asking not what might happen tomorrow, but what is being built today that will define tomorrow. The global energy system is being reconfigured, not through dramatic shocks, but through methodical investments and long-term commitments. Those who understand this early have the opportunity to position accordingly. Those who wait for confirmation in the headlines will arrive too late. The story of China and Venezuela is ultimately a story about how power shifts in the modern world. It shifts quietly. It shifts through capital and infrastructure and dependency. It shifts when one side is patient and the other is distracted. It shifts when incentives align in ways that create momentum that becomes difficult to reverse. The oil remains in the ground in Venezuela. The reserves have not changed, but who controls access to those reserves has changed. That is the shock, not a sudden disruption, but a slow, irreversible transfer of leverage. And in the long run, leverage is what matters most.